Yes. So good evening, everyone. We'll start the session. So in today's session, we are going to decode few terminologies, few technical terminologies related to funding. So what are convertible notes? What are convertible debentures? What are convertible preference shares? We'll be digging more deeper into all those things. I'll try to make it very simple for you. If there is any query in between, please feel free to ask because it's a bit complex topic. Yes, is my screen visible? Okay, okay. Yeah, so decoding convertible notes, CCDs and CCPS. So most of you might be founders or startup enthusiasts or who follow the finance world, and you might have come across these terminologies at least once in your lifetime. But most people doesn't have much clarity on what these instruments actually are and what is the key difference between these instruments and what is the difference between an equity and these instruments. So here in this session, I'll be trying to explain these concepts in a much more simpler manner. So what are the areas we are going to cover in this session? So firstly, what is equity versus debt? So a clear differentiation between what is equity, what is debt. That's the first thing what I'll be explaining. Then why founders and investors use hybrids. So when I say hybrid, this convertible note, CCD, CCPS, etc. are hybrid instruments. When I say hybrid, is actually a debt but can be converted to equity. So that's kind of a hybrid nature. Then what is CN, CCD, CCPS, what they are, how the economics work, what is a discount, what is a cap, what is preference, all those things. Then founder checklist, like what all are the key terms you should know, what all are the compliance, what are the common pitfalls, all those things will be looking. And a few ground rules or a few areas what I've kept assumed is all the things what I'll be telling is based on India based context. Then the legal tax things I'll be touching upon only on a high level, be going much deeper into such things. If you have doubt, you can feel free to ask. And I'll use example to explain you mechanics, not the terminologies. And in case if it gets I mean, what it gets tougher or it gets difficult for you to follow what I'm telling in between, please feel free to ask. Like unlike other session, this is going to be a bit more technical. That's why I'm telling that. Okay. So if you look at the, the thing what I have mentioned there, like these instruments are ways to answer two questions without fighting on data. What is the valuation and what protection does the investor get until then? So these two questions are actually being addressed by these instruments. Okay. So we will check how this is happening. So firstly, we will try to understand what is the difference between equity and debt. Okay, like most of you might be knowing this, but I'm just starting from the basics so that you will get to understand about all those things in the next coming slides. So first thing is ownership. So in equity, the investor becomes an owner today. Okay. In debt, the investor is a lender today. The investor is somebody giving a loan. Okay. In cash flow perspective, for equity, there is no obligation to pay. If you make profits and declare dividend only, you have to pay to the investor. But in debt, you will have to pay interest and you will have to repay back the principal as well. Okay. In case of control, equity typically have voting right and also shareholder approvals or shareholder controls. But in debt instruments or in debt, there is no voting right or anything else unless and until if it is negotiated separately. Okay. Then downside protection. In equity, it is lower, depends on rights. In debt, it is higher. So when I say downside protection, if the company currently is valued at say 30 crore, but in the business is not going well, the numbers are not that good. So in the next fundraising round, they may have to come down to 20 crore valuation. In that case, the protection for equity is comparatively less compared to a loan, because in loan, whatever you have given, that is the amount that you have given, and you are going to get interest irrespective of the value of the company. and also the repayment priority also. So in case if the company doesn't perform well and you have to wind down the company, you have to first repay the debt and then only you can repay the equity back. Okay, so downside protection is lower in equity, it's higher in debt. The valuation fight in equity, it happens immediately. Like on the day of signing itself, you will have to agree upon the valuation. What is the value of the company? How to determine that? On what basis you have arrived at the value? All those questions come on day one itself. But in debt, it can be postponed to a price round. So when I say price round, I'll explain that concept again in the next before going to the next slide. But can be postponed to a price round. Let us keep it like that for now. Then convertible note, CCD, CCPS are hybrid. Like I've told, they behave like debt now and become equity later, usually at the next funding round. Okay, so what is a priced round and an unpriced round? So I'll tell you that. So typically in fundraising, valuation is not actually a mandatory thing. So priced rounds are the rounds where we actually fix a value for the company and then raise. There can be unpriced rounds also wherein we tell that currently the valuation is not being fixed. In future, when we do it, because you'll have to do price round at some point. But in early stage companies, it's sometimes difficult to find the value of the company because you may be in a pre-revenue stage. So you cannot apply a revenue multiplier. And depending wholly on your projection and then doing a discounted cash flow may not be like kind of convincing for the investor also. So it's better you do an unpriced round now. And when you have more clarity on the valuation terms, you do a price round. So in simple terms, price round is a round wherein you specify the valuation and raise the fund. Unpriced round is a round where you don't specify a specific valuation. You're raising a fund now and you will be like kind of converting it to equity or like kind of doing the ownership percentage at a later price round. Okay, hope that is clear. I'll move to the next slide. Okay. Sorry. Okay. So why startups and investors use convertible note, CCD, CCPS? This is what we actually need to understand why typically these sort of instruments are promoted in the startup world primarily. Okay. Before knowing more about or like what are the characteristics or what are the difference of these instruments, we need to know why startups and investors use these instruments. Usually speed now plus valuation later plus protections in between. So there is a lot of flexibility coming up with this instrument. So from a founder or startup point of view, why startups? So this I'll first explain the founder point of view here, then the investor point of view. So from a founder point of view, if you want to close the round faster, these are the best instruments you can go because there is less negotiation on valuation because you are not fixing a valuation now. There is less negotiation on rights, like kind of only few rights you may be agreeing upon now, maybe fewer rights would be coming up only once you convert. Okay, then like kind of delay valuation until you have more traction and a stronger story. Like I've told earlier, see if you are a pre-revenue company and you do a price round, you may have to issue shares or like kind of take investment by diluting a higher percentage. That means that the value of the company is less because you are in a pre-revenue stage. But you're confident that your company will scale up in next 6 months or 12 months. The best instrument you can use is a convertible instrument. It can be a convertible note, convertible debenture, or a convertible preference share. Okay, so that you can delay the valuation for next 6 to 12 months. And once you have a stronger story, you can pitch for a higher valuation. Okay, then reduce immediate dilution and cap table complexity early on. So once you give convertible instruments, typically these people won't be coming in your cap table. Obviously, they'll be coming in your diluted cap table, but in your undiluted cap table, these people won't be coming. Then bridge between rounds when runway is the priority. So for example, you have already raised a seed round of say 2 crore rupees. That money is going to finish off in next 2 months. Okay, but you are planning for next round only after 1 year. So you need a cash flow to manage the operations for next 1 year. So that is where people typically do bridge rounds. So bridge round is actually a round between two proper fundraising rounds. So in case of a bridge round, when runway is the priority, you want money fastly, but you are not ready to like kind of do the valuation. You are not ready to go for a proper DD or like kind of all those things. That is when like kind of you can use these sort of instruments. Okay. Avoid redoing share price frequently in very early stages. Again, what I've told earlier also, like you needn't see doing a price round comes up with lot of compliances. Like you have to get a valuation report from the registered valuer. If there is a foreign investment involved, you have to get the valuation report from a merchant banker also. And all the compliances and everything is going to cost you somewhere around like 1.5 2 lakh rupees for every round you do. So if you're doing like small rounds, for every round, if you're going to spend like 1.5 2 lakh rupees, it's going to be hell lot of money just for the compliance alone. Okay, so it's better you do these sort of rounds and keep the compliances minimal, so that when you do a price round, you can incur this cost in that round and like do everything in a proper organized manner. Okay, now from the investor side, get downside protection versus straight equity. Like I've told earlier, straight equity means like there are a lot of restrictions. You also, from an investor angle, the investor also becomes a shareholder like the founder. So whatever down this is coming for the founder, that will come to the investor also. So for the investor to protect their rights, they prefer to have convertible instruments. Okay, then get upside alignment through conversion into equity later. So if the value of the company is going up, okay, so typically in conversion, what typically they do is like they get a discount on the valuation. So if the company grows rapidly in next 6 months and you are holding a convertible instrument, I'm telling the investor POV. Okay, so the investor is holding a convertible instrument and the company is growing rapidly. So the investor would be agreeing to convert his convertible note or debenture or preference share into equity at a discounted valuation. So you get the upside alignment also there. Okay. Then standardized terms across multiple small checks. So when there are multiple people joining in the same round, it actually helps them. This convertible instruments help them to standardize the terms. I mean, because they have fewer terms, so it's easy for them to align and come into the company. Then use liquidation preference or covenants, more common with CCPS. So when I say liquidation preference, in the case of a company winding up, so for example, if you are holding equity, okay, if you're an investor and you are holding equity in a company. So I'll tell you a scenario. For example, the company raised, say, 1 crore rupees. The company spent around 10 lakh rupees in equity. Sorry, in as marketing and all those expenses. 90 lakh rupees is there in the bank account of the company. Okay, the company raised 1 crore at 10 crore valuation. The investor is holding 10% of the company. Founders are still holding 90% of the company. For some reason, after spending 10 lakh, the company realized that this is not going to work. So they are going to close down the company. But there is 90 lakh rupees in the account. So how are you going to distribute this 90 lakh rupees? So in this case, ideally, you should be distributing in the ratio of your shareholding. So the founders should get 90% of 90 lakh and investors will get only 10% of 90 lakh. So the founders will get 81 lakh and investors will get only 9 lakh. But the investor is the person who has put 1 crore in your company. So that is not right from an investor point of view, that they have put in 1 crore and with the 90 lakh remaining, they are getting only 9 lakh back. Whereas the founder, when he is winding up the business, he is getting 81 lakh to take home. So that doesn't work. That is where liquidation preference come in. So if you hold equity, you will be able to do the split in this manner only. But if you are using a convertible preference share or a convertible debenture or a convertible note, you typically get preference over the equity shareholders. So if you are holding CCPS in this company and this company is winding up, only after your 1 crore is paid off, then only the equity holders will be getting any amount of money. So in this case, this 90 lakh will be coming completely to the investor. So that 10 lakh anyway, they will have to write off as loss. So that at least that 90 lakh will come back to the investor. Okay. So for liquidation preference, they use this sort of instrument. Then match instrument to constraints, like for managing the tax and all those things also, it's better go with the CCPS or CCD round. Okay. Then key message: these are not better than equity. They are tools for a specific moment, early stage or bridge or uncertain valuation. Okay. So I'm not telling that CCPS or CCD or CN are better than equity, but these are tools for that specific moment. Okay, now convertible note, convertible debenture, convertible preference share. So we'll actually look at the difference between this. So same goal, different legal form plus economics. So firstly, legal form. In convertible note, actually there is no instrument per se. So it's just a debt instrument. I cannot say an instrument, it's just a note. It's an agreement between the investor and the shareholder that they are giving X amount of money, whatever terms they have agreed. So that is more like loan now, shares later. Whereas in CCD, it's a debenture that is being issued. So it's a debt security. In CCPS, it's a preference share. It's equity with special rights, equity with preference rights. Okay. Then typical stage. Convertible notes are typically issued at seed stage or a bridge round, especially small round. CCD is also used for bridge or structured rounds. So there will be an interest plus conversion element in that case. Then CCPS, most common for VC rounds, priced equity round. So typically in priced equity round, VCs go for CCPS, but you can do for unpriced rounds also. Then return while outstanding. Usually no cash return. In convertible note, typically there is no, return, cash return. But either way, you can specify return also. That can also be done. In CCD may carry interest. There will be an interest component included typically, but in most of the investment deal, they keep it like 0.001%. It's almost equal to 0. Then in CCPS, dividend rights exist. Okay, often non-cumulative. So when I say non-cumulative, only if you have profits or you have declared dividend only, you will have to pay the dividend. If you haven't declared the dividends, it doesn't get accumulated over a period, this dividend. And typically in CCPS also, the percentage of dividend is typically 0.001%, which is almost equal to 0. Then investor protection, discount or valuation cap plus maturity rights in convertible note. In CCD, it's interest plus conversion ratio. In CCPS, it's liquidation preference plus protective provisions. Okay, so I'll tell you like what is discount, valuation gap model in the next slide. That's why I'm not explaining that too much. So founder watchouts, cap table surprise at conversion. So you need to be clear about how is your cap table going to look after the conversion. Okay, then maturity pressure. So like when the convertible note is going to be mature. So it's a 5-year convertible note. So within 5 years, you will either have to convert or repay it back. When you're going to near 5 year and you haven't done much traction, so that is going to be a pressure for you. So you need to negotiate those terms upfront properly. Then CCD, it's a debt-like mindset, interest plus terms plus conversion math. Like you'll have to pay interest, like I told it could be a negligible interest, plus what all are the terms and how it is going to get converted. Then in CCPS, preference stack plus veto rights plus economic overhang. So there will be preference. You should check whether voting rights are assigned to the preference shareholders, and what is the economic benefit or economic control that the investor is going to have. Okay. So I think somebody CCD or CCPS. So CCD is compulsorily convertible debenture. CCPS is compulsorily convertible preference share. Okay. So we'll explain convertible note now. So convertible note, loan today, shares tomorrow. So convertible note is actually a new concept in India. At least this was introduced only for startup. This is more similar to the safe notes, which is prevalent in US. That's why people typically say iSafe notes or Indian safe notes, but there is no legally a safe note in India. Okay. So safe note, if you know, it's called simple agreement for future equity. So it's similar to safe notes. So the safe notes Indian version is convertible note. Okay. So it's the simplest bridge instrument when valuation is uncertain. So how it works? Investor gives money now, company issues a note acknowledging the debt. Okay. So that's basically going to be a convertible note agreement. Later, the note converts into equity when a priced round happens. So you know what is a priced round and what is an unpriced round. So when you're raising funds at a priced round, you'll be the equity will be, it is getting converted to equity. Conversion price is usually sweetened using a discount or a valuation or valuation cap. Okay, so discount and valuation gap, all those things I'll be explaining in the coming up slides. But there is going to be a benefit for the investor who is putting money now. So for example, an investor is coming now. Okay, so they are putting 1 crore rupees into your company. After 5 years, your valuation is 100 crore. And you are converting that 1 crore to 100 crore. 1 crore at 100 crore means that the investor is going to get only 1%. That is not right. I mean, because the investor has put money now, the valuation of 100 crores after 5 years. So they need to get some benefit because they have come in early. Okay. So that is going to be that is the discount or valuation cap thing, which I'll explain to you in the coming slides. If conversion event does not happen, the note hits maturity. So if the conversion event can we can specify in the agreement. So it can be mentioned as a priced round, or it can be like kind of when the company achieves a turnover of say 50 crore, the convertible note will be converted into equity. So the trigger event can be anything what you define. So if it does not, or the conversion event does not happen, for example, the company does not attain 50 crore turnover and the convertible note is valid for say 5 years. For example, its maturity period is 5 years. Then in that case, you will have to repay it. Whatever terms you have agreed, you will have to repay it. So key founder question, or the key thing what you have to be concerned about is what happens if we do not raise in time. So if you don't have a proper fundraise happening in the time, then this convertible note is going to be a headache for you. Okay. So again, telling about the legal point of view. So this India quick check area is going to be the legal purview of this. So definition, it is issued by a startup. Money is debt first, repayable at holder option or convertible. Only DPIIT recognized startups can issue convertible note. A private limited company which is not recognized by DPIIT cannot, which is not a registered startup, cannot issue convertible note. Convertible note is applicable only for startup registered in India. Okay, it cannot be issued by LLP, it cannot be issued by partnership. It should be a private limited company with DPIIT startup recognition. Time limit for conversion should be maximum 10 years. So it was 5 years previously, it got extended to 10 years. Then more than 25 lakh per tranche. I mean, this is not just for non-resident, for resident also. So each tranche, so for example, you are raising a convertible note round of 1 crore rupee. Okay. And the investor is transferring the money in tranches. Each tranche should be about 25 lakh. For example, if the investor transfers 50 lakhs in the first tranche, okay, it is permissible. In the second tranche, they transfer 30 lakhs, it is also permissible. But the last tranche, if they are going to transfer 20 lakh, then that is not permissible. That is going to be illegal. So in that case, the investor will either have to put in another 25 lakh to legally be valid, or he'll have to do it in some other manner using a CCD or CCPS. If you have to do convertible note, it has to be 25 lakh per tranche. I mean, minimum 25 lakh and above is the permitted thing. Also appears as not as deposit, carve out when, I mean, that's from the legal point of view. I mean, I'm not touching that much deeper. Now, CCDs. So CCDs, compulsorily convertible debentures, debt security that must become equity. That's why it's a compulsory convertible debenture. You should be converting it to an equity. Here you don't have an option to convert it or not convert it. It should be converted. It's compulsorily convertible. Okay. So how CCDs work? A debenture is a debt instrument issued by a company. Think like a bond. Okay. So CCD is compulsorily convertible debenture. It must convert into equity as per agreed terms. It may carry interest, cash pay or accrued, and added to conversion amount. So for example, you are raising CCD of 1 crore with 10% interest, and it is to be converted after 3 years. You can opt not to pay the interest and then convert. That is, for 10%, 1 crore becomes 1 crore 10 lakh after 1 year. The 10 lakhs get accumulated there. Then again on 1 crore 10 lakh, 10% comes, it becomes 1 crore 21 lakh. Then it becomes 1 crore 32 lakh, whatever. And when converting, you will have to convert 1 crore 32 lakh and not 1 crore. Okay. Conversion can be fixed or formula based. It can be linked to Rex round, or it can be fixed also. So one convertible debenture is equal to 1 equity. That can also be done. Or whatever is going to be the next round value, we will convert it at that 20% discount on that value. It can be in that manner also. Debenture holders normally do not have voting rights, okay, unless separately structured. So if there is no explicit agreement that they are having voting right, then they don't have voting right. Okay. So Companies Act allows debentures with an option to convert into shares. Special resolution. Deposit rule CCDs come within 10 years fail under not as, again, like kind of companies are not accepted to accept deposit. That's why that thing I mentioned here. For non-resident, convertible debentures are treated as equity instruments under FEMA, only fully and mandatorily convertible. So if you're doing an optionally convertible debenture or a non-convertible debenture, it will not be treated as equity for FEMA purpose. So in FEMA, like when it's a equity purpose, the compliances are much lesser compared to a debt instrument. Okay. Then CCPS, equity with special economics, and then converts. Most common instrument for VC rounds in India. So preference shares sit within equity, but have preference on payouts. Like I've told earlier. So when the company winds up, first you will have to pay to the preference shareholders and then only the equity holders. So they have preference. That's why it's called preference shares. Then CCPS must convert into equity shares as per agreed triggers. So here also the conversion terms will be specified, but this also must be converted. It is again compulsorily convertible. Okay, it's not like kind of optional, it's compulsory. Common investor economics, liquidation preference, anti-dilute, and sometimes participation. So why investors prefer convertible preference share is because one is liquidation preference, what I've told. If the company is winding up tomorrow, they typically need the money upfront or like kind of all those things. Or even if, for example, tomorrow the company is that 1 crore, same example you take. Okay, 1 crore is the investment by an investor. They got 10%. They're holding 90%. You are holding 10%. This is a preference share. Tomorrow the company is being sold for 5 crore. In that case also, first investors 1 crore get repaid. Okay, that is the protective provision that they keep, and the remaining 4 crore is divided in the ratio of 90:10 between founder and investor. Okay, so that's why liquidation preference is there. Then anti-dilution. Why? What is anti-dilution means? So if you're going for a down round, for example, you raised from this particular investor at 30 crore, and in the next round you are forced to raise at 20 crore. Business is not going good, or for some reason it is not working. Like 30 crore is not going to work. In that case, they can keep special terms so that their preference share will also get converted at 20 crore valuation to match whatever percentage they are holding, or to maintain that ownership. Okay. Then sometimes participation is because they can participate in the board meeting and all those voting rights and everything. Then common control terms, protective provisions, board rights, information rights. All these things typically preference shareholders would be, or investors would be asking. Founder reality, CCPS is often standard venture equity. Okay, so if you are going for a VC round, CCPS is the most common instrument that you are going to see. Then preference share must be redeemable. Typical tenor is up to, I mean, this is not applicable for convertible preference share. Optional clauses are allowed within lock-in, but cannot, I mean, these are not that important. Those are from compliance perspective. I'm not touching up on that. Okay, now we'll go to an example. This will give you more clarity on discount, valuation gap, and all those things. Okay, the economics, discount and valuation gap. Okay, how investors get reward for taking early risk. So this is the setup. Investor puts rupees 1 crore via a convertible note. Next priced round sets equity price at rupees 100 per share. Okay, so the share price of one share is 100. Okay, note terms, 20% discount and valuation cap equivalent to rupees 70 per share. This is the notes terms. Okay, so now let us analyze this scenario. We are computing the conversion price. Okay, so what is the price of the share? It is 100 rupees per share. What is the discounted price for this particular investor? They are having 20% discount. So 20% discount means 100 into 20 rupees. If you less that, you'll get 80 rupees. Okay. What is the valuation cap? 70 rupees. Okay. So conversion price is equal to lower of the two. You have to take lower of the two. Again, valuation cap is the maximum value you can offer to that investor, or maximum price you can offer to that investor for conversion. So for example, tomorrow or like if the valuation cap is 90 rupees, okay, in that case, this 100 becomes, you get a discount of 80 rupees, but the valuation cap is 90. So in that case, you will convert it at 80 rupees. But here, since the valuation cap is specifically mentioned, you cannot, even though the discounted value is 80 rupees, but there is a specific valuation cap mentioned, you cannot go above that valuation cap. Okay, so you have to convert the shares at rupees 70 per share. So the number of shares that the investor is going to get upon conversion is 1 crore divided by 70, which is approximately equal to 1,42,857 shares. Okay, so what if ideally if the investor, the shares were getting converted at 100 rupees, the investor would have got only 1 lakh shares of the company. But now, since they came in at an earlier round and they negotiated a discount percentage and a valuation cap using a convertible instrument, they're going to get 1,42,857 shares, which is like 43% more than what they would have ideally got. Okay, and why investor is getting this extra shares is because they have taken the risk at an early stage. When your company was small and when you're not generating revenue, the investor has taken the risk to bet on your company. That is why they are getting that extra shares. Okay. Discount and cap are not free money. They are delayed pricing. Okay. Model dilution at conversion on a fully diluted cap table. So that is like you have to, when structuring the deal itself, you will have to work out what if the shares get converted at 70 rupees per share? What is the number of shares that I'm going to give to the investor? You have to understand the dilution percentage upfront itself. Like what is the worst percentage or what is the most high percentage that you're going to give to the investor? So these all things you need to keep in mind, because if you negotiate the valuation cap to say 30 rupees, then the investor is going to get hell lot of shares, which means that majority of the company is gone. So those are things which you need to keep in mind. You need to create a cap table before finalizing the terms. Okay, you need to understand how much you are going to give. Conversion and exit scenarios, what usually triggers conversion and what happens if it doesn't. So next price round is the most common thing. So typically convertible note or CCD are converted at discount or valuation cap. CCPS may convert into equity at agreed ratio. So there will be a ratio agreed, like 1:1. When I say 1:1, one for one preference share, one equity share you will be giving. Or it can be for two preference share, you will be giving one equity. There can be ratios like that. So this typically happens in the next price round. This is a common scenario what we have seen where conversion happens. Then maturity date arrives. So there will be a maturity period, like it is for 5 years. Then at that time you'll have to convert. So these are the conversion scenarios. Okay, like when you have to convert and when you get exit. Okay, then next is exit or acquisition before next round. This is again a most common thing. Why? Because in most of the cases, typically investors don't want to convert into equity and be an equity shareholder in the company. So when an exit or acquisition happens, that is the time when they convert and then they become equity holders and then they take the return and go. Okay. Then down round or weak performance. So like I've told, when the valuation goes down, in that case, the investors may convert the CCPS into equity to secure more control in the company. Okay. Again, model scenarios, not just valuation. So you'll have to model all those scenarios, what is going to happen, and understand what is the dilution that you're going to have. Okay, again, key terms founders should recognize and translate. So economics versus control. So economics, who gets paid and when. So liquidation preference is investor gets money back before common shareholders. What I've already told. So before equity shareholders, the investors would be getting their money back. Participation, investor can get preference and share remaining upside, more aggressive. They can participate in the business, they can have voting rights and all those things, and also get upside return also. Anti-dilution, adjust conversion price in down rounds. Like I've told earlier, you have raised funds at 30 crore now. Next round is happening at 20 crore for some reason. In that case, the investor gets to adjust their conversion ratio and secure more equity in case of a down round. Okay. Then dividends or CCPS often non-cumulative and only if declared, like I've already told. Then conversion ratio or formula defines how much equity the instrument becomes. So this also you should be like very clear, and again you'll have to work out model scenarios on how your cap table is going to be in a best case scenario and in a worst case scenario. Then from control aspect, who can block what? So protective provisions, veto on key actions, new shares, debt, M&A budgets, all those things are typically the conditions where investors typically involved. You'll have to get an approval from the investor before proceeding on uh, a few things. Typically in a shareholders agreement, we write those things as reserved matters. For what all things are mentioned in the reserved matters, you will have to get an approval from the investor before proceeding, for issuing new shares, for taking loans, if you're going for an M&A, if your budget exceeds 10% of what you have planned. Okay, then board rights. Typically, the investor would be asking for a directorship or a board observer kind of role to know what is happening in the business. Then information rights, monthly MIS, audited statements, budget, etc. Typically, the investor would be asking a right because they need to know what is happening in the business. Then transfer rights, ROFR is right of first refusal, tag along, drag along. So once the investor comes in, ROFR, tag along, drag along, maybe I'll explain in detail in upcoming sessions. These are key legal terminologies associated in a shareholders agreement. But for a common understanding, drag along is something wherein an investor gets a deal. Okay, the investor brings in a potential buyer, and for example, you have to give exit to the investor in 5 years. That is what you have mentioned in the agreement. But after 5 years also no exit has happened. In that case, if the investor brings a potential buyer, they can drag you also along with them to sell the entire shares of the company. That is drag along rights. Then tag along is when the founder finds a potential buyer, along with you selling the shares, you will have to tag investors shares also with that shares to sell, because investor also need to get this one. Then right of first refusal, for example, if you are transferring your shares, you will have to first offer to the investor, and then if they refuse only, you can transfer it to a third party. Then founder vesting or ESOP pool, often negotiated alongside the instrument. So those are again you have to understand all those things. Like there will be a founder vesting, means that if you are holding 10,000 shares in your company, the investor can put a vesting schedule for that as well. It doesn't mean that you'll be holding you are holding 10,000 technically, but when I say vesting schedule, they want you to be in the company for next 5 years. So they are telling there is going to be vesting for your shares. So if you exit the company in 3 years, you won't be getting 10,000 shares, you'll be getting only 5,000 shares. So they can put controls like that also. Okay. So rule of thumb, founders should always ask for a cap table model and an exit payout model before signing. So those things you will have to ask, or you will have to ask your chartered accountant or your legal counsel to work out on those things. Then again, compliance checklist, do not skip the boring part. This is another area where typically founders mess up a lot, because they focus more on getting the funds into the company rather than staying the company compliant. So firstly, on a corporate law level, the articles must permit the security. If be it a preference share or a debenture, your articles of association must be having that particular clause that you can issue these instruments. If not, you will have to amend the articles. Then board approval plus shareholder special resolution where required. Those things you have to obtain. Then private placement process, all these in the case of CCPS and CCD, these issuers are called private placement. So you'll have to issue offer letter. You'll have to there are timelines for allotment. There are if you're obtaining a valuation report, there is a timeline for that. You have to file a lot of filings with the registrar of corporate affairs, and there are many registers to be updated. Okay, then instrument docs, term sheet would be there in the initial stage, which get converted to a SSA or a share subscription agreement or a shareholders agreement, if applicable. Then cap table plus ESOP pool updates, keep fully diluted view. That's what I've told already. In diluted cap table only, you will be seeing what everybody is going to on after everything gets converted to equity. So you need to have a diluted view in that case. Okay, because if you are taking the undiluted cap table, you may feel like you are owning so much of the company. But only if you take the diluted cap table, you will understand how much percentage you are actually going to own. Then from a FEMA point of view, check the entry route, sectoral caps, and whether approvals are needed. There are few sectors where actually restriction is there. There are few sectors wherein there is a cap. For example, in media industry, you cannot get more than 26% foreign direct investment. So those things you need to check. Then pricing or valuation for unlisted companies, valuation via internationally accepted method or certified by a CEO or a SEBI registered merchant banker is required. Then optionality clauses allowed within lock-in but not assured exit price for non-resident. Then after that, you'll have to do the RBI reporting in the firm's portal. Then to keep the documentation ready, KYC, valuation report, resolution agreement, FARs, foreign inward remittance certificate, all those things you have to be keep handy. Okay. Then clean filings plus clean valuation report plus clean cap table. That's the like kind of mantra you should have. Then in case of tax and accounting, I'm just touching upon going these things. Interest, you will have to, if there is an interest for the CCD or CN, you'll have to pay TDS. You have to consider all those things. Then dividends on CCP are taxed in the hand of shareholders. So those things the shareholders have to take care of. Then angel tax is not there now, like in the last budget they have removed, but still ensure that you have proper valuation documentation wherever necessary. Then cross-border deals, watch withholding tax, that's the TDS again. Then double taxation avoidance agreement and all those things. Then accounting, classification depends on terms. So whether to treat as a debt or equity, those things again, like you'll have to speak with your auditor and CA and understand all those things. Then CCPS can be equity-like, but redemption or mandatory payout features can change classification. Yeah. So if you change all those things, like the nature of the instrument can change. Then conversion options may create embedded derivatives in some frameworks. Document the terms clearly. Auditors will ask for exact conversion mechanics. Okay, so there should be a proper agreement. There should be like what are the conversion terms. All those things should be properly documented and signed. Practical founder habit: keep one folder with valuation, cap table, agreements, and filings updated after every round. Okay, this will help you in DD also. Then what are the common pitfalls and quick fixes? Okay, so typically pitfalls are short maturity plus slow fundraising is equal to investor leverage at worst time. I mean, so you have your maturity of the instrument happening in 3 months and your fundraising is going very slow. That means that the investor is going to have a lot of leverage on the conversion terms. Okay, so that's something what typically founders make the mistake. They go and raise funds when they need money today, or like they would have needed money yesterday. So you have to plan for your funding. Then vague conversion formula or missing qualified financing definition. So again, like you have to mention the terms properly. You have to understand what is the term of conversion. Don't just give vague formulas. Consult a lawyer, consult a company secretary, or consult a chartered accountant, whoever necessary. So if you are raising 1 crore rupees in capital, at least you will have to spend spend 2 to 3% just for the compliance alone. So you hire a good CA or a good lawyer who understand the terminologies. I mean, don't try to save on this cost. If you try to save on this cost, you will be bleeding a lot of equity or bleeding a lot of money in the future. Then multiple preference stacks around rounds and unexpected exit outcomes. So so if you are giving the liquidation preference or preference to the preference shareholders, and there are multiple levels of preference. Okay, so in that case, what happens, or we are giving 2x preference to the investor, which means that an investor who puts in 1 crore, they should ideally get 2 crore back, and after that only the exit amount would be distributed in the shareholding ratio. So there can be things like that. So read the exit conditions properly and set the preference also properly when there are multiple rounds of fundraising. Who has the preference over whom, and what you are going to make finally after an exit, that should be clear. Then assured return or put options in cross-border deals, you are guaranteeing more return what you actually can pay. So in that case, it's going to affect the cash flow, and there can be in the case of FEMA, also it can be treated as a debt, and then it can be a violation also. Okay, then skipping filings or valuation reports, delay in the next round due diligence. So if you skip the filings for this round, or like if you don't get a valuation report when it is mandatory, that is going to be a red flag in your next DD, and the next fundraising would again get delayed by 2 or 3 months, and you'll have to pay a lot of amount as penalty also. Then not planning ESOP pool early. This is what I have seen commonly. Founders get diluted twice, pool plus round. So what happens is like you have to plan for your ESOP pool upfront itself. So I mean, you bring in an investor now, and that investor is having 10% in the company, and tomorrow you want to create an ESOP pool for another 10%. So what is going to happen is the investor's 10% would become 9%, your 90% would become 81%, and the ESOP pool would become 10%. The investor would not agree for that 1% dilution. Why? Because they are not making any value. So if you are raising funds, the company's value is increasing, and they are making at least like an unrealized value. But in the case of creating an ESOP pool, they are not going to make any value, so they won't permit you to do that. In that case, they will ask to like sacrifice the entire thing from your capital. So your 90 is going to become 80. So you need to plan for ESOP pool early and like understand how the cap table is going to be. And the quick fixes model 3 scenarios, like what is going to happen in an up round, what is going to happen in a flat round, like in a normal case, what is going to happen in a down round. Okay. Then keep terms short and clear. Define triggers and defaults in plain language. Don't go for complex language and like make it vague and like make it non-understandable. Like draft it in a clear and short manner. Negotiate maturity with runway realism. Consider extension mechanics. So you will have to negotiate the runway maturity. I mean, if it is going to get converted into 5 year, or you have to repay the convertible note in 5 year, whether that is going to match with your runway is what you have to check. Okay, whether you will be having that much amount of fund after 5 years to repay this loan, or if not, you are not able to repay back. What are the possible way you can extend the maturity to another period? So all these things you should keep in mind. Okay, and you should bring all those things into document. For CCPS, ask what is the preference? Is it participating? Any caps? All these questions you'll have to ask. Okay, maintain a due diligence ready data room from day one. This is what I typically tell everyone, and I encourage all my clients to do. And wherever we have an engagement, what we typically do for our clients, you have to keep your DD room ready, data room ready from day one itself, so that if you're going to have a DD, if you're going to raise funds, you can send this data room out to the people who are doing the DD, and they can review your documents easily. So a quick recap. So convertible note is the fastest bridge. Watch maturity and conversion math. CCD, debt security that must convert. Okay, so it's compulsorily convertible. Often includes interest and stricter terms. CCPS, venture standard equity economics, model liquidation preference outcome. What I have told already, you should be modeling how your equity is going to be distributed to the investor. In case what is the dilution going to be? Always ask for two models: dilution at conversion plus exit payout waterfall. So how is the exit payout going to work? What is the dilution at conversion? These two models you'll have to always ask. Then compliance hygiene is not optional. It affects your next round and your exit. So maintain compliance hygiene from day one onwards. Okay. So yeah, so that's it from my end. So if you have any questions, you can ask now.
Hi Abhijith, good evening. Hi, this is Sheikh here.
Hi, Sheikh.
So Abhijit, I have just a question. So if government is nowadays offering grants through a lot of incubation centers, okay, so and also parallelly angels are doing the due diligence. So is there any difference from the government backed due diligence and the angels backed due diligence? So how does it differ?
I mean, typically, see, it depends on the agency or the consulting firm they are engaging. So when I do DD, I have a standard checklist and I have a standard practice. And when I do it for, I do DD for in multiple cases. So I work for VCs. In that case, they have a specific set of requirements. So I try to cater that. Then I have done DD for a company who is acquiring a smaller company. In that case, it is more stricter because that acquired company is going to be the responsibility of the acquiring company. So there it's more stringent. in case of government DDs, like it should be similar to what angels are doing, but again depends on the agency who is performing. I mean, it should be similar, but again for DD there is no hard and fast rules. You can verify whatever you want. So, I mean, that would be my answer.
Okay. So in that case, what I understand from you is that most of the cases are similar. Okay,
Yeah.
it should be strict. Okay.
But in the case of acquisition, it's going to be much more stricter.
Yeah, acquisition it should be. Yes. Because these are all government grants and all those comes at a very early stage. So I'm just thinking whether those things are all completely similar to what VCs angels back to do. I mean, that's what I'm just trying to understand.
Yeah. Okay.
Okay. Thank you.
Anyone else have any questions?
This debentures and bonds are like FDs, or is it different?
I mean, see, debentures are actually not FDC. That is from an investor perspective. Okay. From a so debenture would be actually having a coupon rate or like kind of an interest percentage. But in the case of equity financing or in the fundraising thing, typically the rate of interest is very negligible. It typically would be like kind of 0.001% or something like that. And it should be mandatorily getting converted to a equity. In the case of FD, it's more like kind of you're investing somewhere, you're getting the interest and you're repaying the entire money back. So that doesn't work in a compulsorily convertible debenture. But if it's a non-convertible debenture, yes, it's more like an FD.
So here we discuss three things. The first one is we are giving money, right? That's safe notes.
Yeah.
After 5 years, they'll pay the interest, then it will be converted.
I mean, interest you need and pay. Like you can accumulate the interest and get converted on that value
into equity. And second one was converting, right?
Convertible debentures, and then the third one is convertible preference share.
Okay, so preferential shares means in the sense of winding down, he paid first, then the other equity.
Yes. So preference share is more like equity only. They are also like kind of treated as owners of the company. But in preference shares, unlike equity, if the company is making say 1 crore profit and you are holding 10% of the company, you are entitled to get 10% of that profit only. Okay, but in the case of preference share, typically there will be a fixed coupon rate. It's more like an interest itself. So that is the profit that you are going to get. And these instruments have preference over equity at the time of exit or like kind of liquidation.
Yeah, thank you.
So yeah, Dairya, you can ask your.
Yeah, just wanted to just wanted to reconfirm on my understanding. So CCPS, CCD, and convertible note, all three we are able to delay the valuation. So if I'm issuing it to a resident investor under the Companies Act, we can issue it at say face value and have the conversion terms set for later. So
Yes.
basically, even if I want to raise 10 crores today, I issue 10 crore CCPS of face value 1 each, convertible into X number of equity shares based on the future value. That
Yes.
all three don't have any repercussions in that as of now, right?
No. And in case of convertible note, like kind of typically there is no face value per se.
Correct. Convertible note is a loan directly.
Yeah.
There's no
kind of a loan agreement kind of.
correct.
And in most of the case, CCDs or CCPS, I've seen like even if the face value of equity shares is 10 rupees, typically like kind of CCD, if you are raising 10 crore, they do it like kind of 10,000 rupees or something like that. They keep
Right.
a higher rate, the face value of CCD.
And the other point I just wanted to clarify was there is also no restriction in the Companies Act to convert a CCD into CCPS and then or CCD into equity, right?
Go to equity itself.
But if the investor is insisting, I don't have is it mandatory to do it into equity or is it optional? Because we had checked and I wasn't able to find any restriction.
I mean, for CCD, you will have to mandatorily convert into equity. The only option where you have option is like kind of an OCD. It's an optionally convertible debenture.
Okay.
Which again, like kind of, I'm not digging much deeper into that. That again
Right.
would play. I mean, it's actually so. I mean, I believe that you are also from a compliance background. You understand a bit of law, is what I understand. So the Companies Act is also a bit silent about OCD. You cannot find anything about OCD anywhere. You can find about NCD, non-convertible debentures. You can find about convertible debentures, but you won't find about OCD.
Right.
So I have seen it as a kind of gray area, or like kind of where it's not mentioned properly. But I've seen to OCDs.
But CCD, you're only taking it into equity, not
Yes.
preferential.
Yeah, you cannot repay it back also.
No, not repaid back. So if I convert it into CCPS and then into equity, I'm still compulsorily converting it.
Yes,
But
I don't. I haven't seen like that. I typically have seen like CCD get converted to equity. Maybe I'll have to recheck on that aspect, but I've never seen that aspect.
Right, got it. Oh, thank you so much. Nice presentation.
Yeah. Thank you, Dhairya. Yes, so Ramkumar.
Hi, Abhijit. Hi, Abhijit. Thanks for the presentation. So you mentioned regarding the CCD that there is a discounted price for the shares, right? Like when you're probably entering valuation. So is there any specific time frame before this kicks in, or is it like fixed right from the day one when you sign the agreement? Could you just?
I mean, see, these are terms which you actually negotiate with the investor. So there is no fixed terms per se. But I mean, like kind of typically, like we have seen like 5 years, 8 years, 10 years are the terms we typically write. But again, it depends on like how you negotiate with the investor, what all are the terms and all.
Sure.
Yeah.
Thank you.
Thank you, Ron. Yeah, Jagdish, you can ask your question.
Thank you, Abhijit. Your presentation was excellent. My question is that generally in CCP or CCD, the investor amount invested in tranches, or it will invest in lump sum way.
Your voice is not that clear. Like there is a lot of background noise.
So I was asking that generally in CCD or CCPS, the amount investor invest is in the lump sum way or in tranches.
I mean, see, it can come in tranches, but there is no specific this one. Like you can put it in lump sum, you can put it in tranches, but you need to comply with the filings, like the past 3 filings or whatever filings you have to do with the ROC. Those should be mandatory, and like kind of typically like kind of once you get the fund within 60 days, you have to allot the security also. So all those things you have to comply. So if you're complying with the rules, you can do it in multiple tranches. You can do it in single lump sum.
Capital gain का वो ज़्यादा लंबा रहेगा तो फिर
We have that restriction of 25 lakh.
Okay.
बहुत सारे आइटम रहेंगे ना.
Okay, thank you.
Capital gain का तुम्हारा.
Yeah, Rohit, you can.
Hi, can you hear me okay?
Yeah, yes.
Okay, so a couple of questions. So one, do this group of investors generally have a whole set of definitions as to everything from salaries for leadership to every single other aspect of it? So could you give me an illustration as to where they tie your hands, as a first question? And a second question, if you have time, are there any specific thoughts you have when investors are coming in from overseas?
Okay, so Rohit, like see, typically like kind of the investors would be having their own. If you're a proper VC firm, or like if you're a angel network, you have been doing like kind of organized funding for a while now. Typically, they would be having a legal counsel, or they would be having a lawyer, and they would be having their own standard terms. In most of the cases, the investors would be like kind of, these are my terms. If you agree, I mean, you can we can go ahead with this. But typically, like kind of negotiation and the terms, I mean, it typically happens when like kind of how strong your business are, and like how confident you are, and when you have multiple investors lined up to put money in the business, that is where you actually have the upper hand, and like you can negotiate the terms with the investors. So from the investor would be definitely having a standard SHA or a standard shareholders agreement or a standard rights, what they typically ask for. But again, like if they are very much keen on your business, they will be open to negotiation and they will be flexible with that. And with regard to foreign investment, like overseas investors coming in, the only thing extra you will have to take care is regarding the FEMA filings, the RBI filings. You will have to like kind of get a valuation report from the merchant banker. You have to do the filings within time, because if you mess up with the RBI filings, unlike other filings, typically like kind of for you to correct those things, you will take a hell lot of time and you will have to pay a lot of penalty. It's very like kind of difficult to get those things corrected after a while. So just make sure that you are compliant enough. If there is a foreign fund coming in, you have to report it to the RBI. So you need to have a company secretary certificate. You need to have a merchant banker valuation report. All those things are mandatory. So just be sure of all those things and make sure that your company can accept foreign direct investment also, because there are certain restricted sectors in India wherein you cannot actually take foreign fund. And there are sectoral caps also, like I've told earlier, 26% is there for the media industry. In some cases, it is 49%. Yeah. Yeah, Param, you can ask your question. Yeah, Param, you can ask your question. We're not able to hear you. If anyone else have any question, you can ask. Okay. Yeah, Param. Yes. Hello. Okay. So, I mean, we're not able to hear you, Param. So I think, so in that case, we'll wind up the session now. So thank you, everyone. Thank you once again for joining the session. We'll be having the next session after a couple of weeks. So until then, like enough, if you want to stay updated about the session, like there is a WhatsApp group wherein you can join, where we post about all the posts and everything. I will be sharing the recording of this session in YouTube. And yeah, I will be sharing the deck also. Okay. So thank you, everyone. Thank you for joining. Thank you for
very much.
Thank you, everyone. Bye. Hope the session was useful. Bye. Good night.